I'm witnessing something happening in China that represents the most dangerous deflationary spiral I've observed in 7 decades of studying global economic cycles. And what alarms me most isn't just the immediate price declines across Chinese consumer goods, real estate, and industrial commodities. It's the mathematical certainty that Chinese deflation will export globally through supply chains, currency devaluation, and demographic collapse that creates systematic demand destruction lasting decades rather than years. The numbers coming out of China reveal deflationary pressures that dwarf Japan's lost decades because China's economy is 6 times larger than Japan's was during their deflationary collapse, while China's demographic cliff is steeper, debt levels are higher, and the real estate bubble that's now bursting represents a larger percentage of national wealth than any housing bubble in modern economic history. We're not watching a cyclical downturn that monetary policy can address. We're watching systematic economic contraction driven by mathematical forces that no government intervention can reverse. What should terrify every American investor is how quickly Chinese deflation will spread through international markets as Chinese manufacturers slash prices to maintain market share while domestic demand collapses. Chinese factory owners facing systematic demand destruction have no choice but to export their deflation globally by cutting prices below cost to generate cash flow needed to service debt obligations that cannot be reduced regardless of revenue declines. I've spent my career studying how deflation compounds differently than inflation because deflationary spirals feed on themselves through psychological and mathematical mechanisms that become impossible to break once they reach critical mass. When consumers and businesses expect prices to fall, they delay purchases, which reduces demand, which forces additional price cuts, which reinforces expectations of further price declines. China has crossed that threshold, and the deflation will compound until debt levels become manageable relative to reduced income streams. The Chinese real estate sector represents the epicenter of this deflationary collapse because property values supported local government finances, household wealth accumulation, and construction industry employment that collectively employed over 100 million Chinese workers across real estate development, construction materials, and related service industries. When real estate prices decline by 40 to 60% from peak levels, as they have in many Chinese cities, the wealth destruction cascades through every aspect of Chinese domestic demand. Local government debt crisis compounds Chinese deflation because municipal governments borrowed trillions based on land sales revenue that has evaporated as real estate development becomes economically impossible when property buyers disappear and construction costs exceed realistic sale prices. Chinese local governments face systematic insolvency that requires either massive central government bailouts financed through money printing or systematic service reductions and employment cuts that accelerate demand destruction. The demographic mathematics underlying Chinese economic contraction are even more devastating than the immediate financial imbalances because China's aging population requires increased healthcare and social support expenditures while the working age population contracts faster than any major economy in history. China faces 28 million annual retirements while birth rates have collapsed below replacement levels, creating systematic labor force contraction that reduces economic output while increasing social welfare obligations. Chinese manufacturers respond to domestic demand collapse by increasing export volume at reduced prices, flooding global markets with goods priced below production costs to generate cash flow needed for debt service and employee wages. This export of Chinese deflation destroys pricing power for competing manufacturers worldwide while creating artificial price suppression that masks the true inflation created by Western monetary policies. The currency implications of Chinese deflation extend beyond immediate trade relationships toward systematic pressure for yuan devaluation that would accelerate global deflationary pressures while reducing Chinese debt burdens denominated in domestic currency. But yuan devaluation would trigger trade retaliation from the United States and Europe that would further reduce Chinese export demand, creating additional deflationary pressure that compounds the underlying economic contraction. European manufacturing faces systematic destruction from Chinese deflation because European factories cannot compete with Chinese manufacturers selling goods below production cost, while European energy costs have increased by multiples due to Ukraine conflict effects. Chinese deflation exports will destroy what remains of European industrial competitiveness while accelerating the deindustrialization process already underway due to energy cost disadvantages. American retailers and consumers initially benefit from Chinese deflation through lower import prices that reduce inflation pressures and increase consumer purchasing power, but these benefits prove temporary as Chinese demand destruction reduces American export opportunities while Chinese manufacturers destroy American manufacturing employment through predatory pricing enabled by systematic government subsidies and debt financing. The global commodity implications of Chinese deflation are staggering because China consumes over 50% of global steel, cement, copper, and other industrial materials that support infrastructure and construction industries worldwide. Chinese demand destruction for commodities will cascade through commodity exporting countries from Australia to Brazil to Africa, creating systematic economic contraction in economies dependent on Chinese import demand. Banking sector implications extend beyond Chinese financial institutions toward international banks with exposure to Chinese debt, real estate projects, and trade financing that becomes worthless when Chinese economic activity contracts systematically. European and American banks face systematic losses on China-related lending, while Chinese bank failures threaten international financial stability through interconnected derivative markets and currency exchange mechanisms. The supply chain concentration risk that developed over 30 years of Chinese manufacturing expansion becomes systematic vulnerability during Chinese economic contraction because alternative production capacity cannot replace Chinese manufacturing volume quickly enough to prevent systematic supply disruptions when Chinese factories reduce production due to demand collapse and financial stress. Technology sector implications affect global innovation capacity because Chinese domestic technology demand provided the scale needed to support advanced semiconductor production, telecommunications infrastructure, and consumer electronics development. Chinese demand destruction reduces the economic viability of advanced technology development while Chinese manufacturers dump excess inventory at prices that destroy profitability for competing technology companies. What concerns me most about Chinese deflation is the timeline for resolution extends decades rather than years because the underlying demographic mathematics cannot be altered through policy intervention. Chinese population aging is mathematically determined by birth rates from 20 to 60 years ago, while current birth rates guarantee continued workforce contraction regardless of government incentive programs or economic recovery policies. The debt mathematics compound Chinese deflationary pressures because total Chinese debt approaches 300% of GDP across government, corporate, and household sectors, while the economic growth needed to service those debt levels becomes impossible during demographic contraction and real estate wealth destruction. Chinese debt levels can only become sustainable through systematic deflation that reduces nominal obligations relative to reduced economic output. International investment implications require fundamental reassessment of Chinese asset exposure because systematic economic contraction and demographic decline make traditional growth assumptions invalid for Chinese equity and real estate investments. Chinese assets face decades of deflationary headwinds that will destroy capital regardless of temporary policy interventions or market rallies driven by foreign investment flows. The geopolitical implications of Chinese economic contraction extend beyond trade relationships toward fundamental questions about Chinese capacity to maintain military expansion and international influence when domestic economic resources must focus on managing social instability and demographic transition rather than external power projection. Economic contraction typically reduces international ambition while increasing domestic political pressure. American economic benefits from Chinese deflation prove mixed because lower import prices reduce inflation pressure, while Chinese demand destruction reduces American export opportunities and destroys American manufacturing employment through predatory pricing. The net effect depends on whether American policymakers can protect domestic manufacturing while benefiting from Chinese import deflation without triggering trade wars that damage both economies. Currency system implications affect dollar dominance because Chinese yuan weakness relative to systematic economic contraction makes yuan internationalization impossible while reinforcing dollar preference for international trade and reserve accumulation. Chinese deflation actually strengthens dollar dominance by demonstrating the weakness of alternative currency systems tied to contracting economies. The social stability implications of Chinese deflation create systematic risk for international investors because massive unemployment, wealth destruction, and reduced living standards typically trigger political instability in authoritarian systems that depend on economic growth to maintain legitimacy. Chinese political stability cannot be assumed during systematic economic contraction that affects hundreds of millions of workers and property owners. Regional Asian economic implications cascade through economies integrated with Chinese supply chains and dependent on Chinese demand for commodities, tourism, and manufactured goods. South Korea, Taiwan, Singapore, and other Chinese economic satellites face systematic economic pressure as Chinese import demand contracts while Chinese export competition intensifies through predatory pricing strategies. The agricultural implications affect global food security because Chinese food import demand supports agricultural production worldwide, while Chinese agricultural productivity faces systematic decline due to demographic aging and urbanization that removes agricultural workers from rural areas. Chinese food security concerns during economic contraction could trigger international agricultural market disruptions. Energy market implications extend beyond immediate Chinese energy import reductions toward systematic changes in global energy consumption patterns as Chinese industrial production contracts and construction activity declines. Chinese energy demand destruction will suppress global energy prices while reducing the economic viability of alternative energy investments that require high energy prices to generate adequate returns. What frustrates me most about this predictable Chinese economic collapse is how preventable it was through demographic planning and debt management that Chinese authorities ignored while prioritizing rapid growth over sustainable development. The Chinese economic model depended on assumptions about continued population growth and debt accumulation that were mathematically unsustainable from the beginning. International portfolio implications require defensive positioning against Chinese deflation exports while avoiding direct Chinese asset exposure that faces decades of systematic headwinds. American assets benefit from Chinese capital flight and manufacturing relocation, while commodity investments face systematic pressure from Chinese demand destruction that cannot be replaced by alternative demand sources. The insurance industry faces systematic exposure to Chinese economic collapse through trade credit insurance, international business interruption coverage, and derivative contracts tied to Chinese economic performance. When systematic economic contraction occurs in the world's second largest economy, insurance losses cascade through international markets regardless of direct exposure limitations. Technology supply chain implications create systematic vulnerability for American technology companies dependent on Chinese manufacturing capacity and Chinese market access that disappears during economic contraction. Alternative manufacturing capacity requires years to develop while Chinese market access becomes politically impossible during economic nationalism that accompanies domestic hardship. The timeline for Chinese deflation resolution extends through demographic transition that requires decades to complete, while debt reduction progresses slowly through systematic economic contraction that reduces nominal debt levels relative to reduced economic output. Chinese economic recovery cannot begin until demographic mathematics and debt levels return to sustainable relationships. Patient capital must position for Chinese deflation exports that will suppress global inflation while creating deflationary pressures that benefit holders of cash and fixed income investments denominated in appreciating currencies. Chinese economic contraction represents systematic shift from growth-oriented investing toward preservation of purchasing power during global deflationary period. Markets reward recognition of systematic economic transitions while punishing denial of mathematical inevitability that demographic and debt mathematics create regardless of political intervention or policy accommodation. Chinese deflation represents systematic force that will reshape global economic relationships for decades while creating opportunities for capital positioned to benefit from deflationary wealth preservation rather than growth-dependent speculation.